If you're not in silver and you see it get back up to 34.90 or especially touch 35 again, assume it's going to launch big time. And I bet at that point, when that occurs, and we think it's going to occur, at that point, silver will launch versus gold. And so silver's relative pricing to gold, which is very cheap right now, historically very low, 1% of the price of gold. It's done that a few times before. And whenever it does, it slingshots, by the way. At that point, that's when silver says, me too. And I think that's about to happen.
Gold's recent breakout may have stunned global markets, but behind the scenes, seasoned analysts are pointing to a far more explosive opportunity. As 2025 unfolds, silver is poised to outshine gold, not just as a precious metal, but as the real breakout story that could redefine the commodities landscape. Michael Oliver, a respected technical analyst and founder of Momentum Structural Analysis, predicts an explosive move in silver and mining stocks based on long-term momentum breakouts and historical structural setups. Oliver's prediction is rooted in his unique analytical framework known as Momentum Structural Analysis, MSA, which focuses less on traditional price charts and more on the internal momentum dynamics of assets over time. According to Oliver, markets often undergo significant internal shifts long before those changes manifest in actual price movement. In the case of silver and miners, he believes that these internal momentum structures have already broken out, an early signal that a dramatic price revaluation is on the horizon. He argues that silver and mining stocks are currently at a structural inflection point, similar to what occurred in other major bull markets, such as those of the 1970s or early 2000s. In those historical instances, silver lagged behind gold initially, frustrating investors and causing many to abandon the sector. But once certain momentum thresholds were crossed, silver caught up and then outperformed dramatically. Oliver sees echoes of that same dynamic now. Gold has already made significant moves, breaking key resistance levels and attracting safe haven flows, but silver and miners have yet to reflect this strength in their price charts. However, from a momentum perspective, he insists that the groundwork for an explosive catch-up phase is already in place. Furthermore, Oliver points to what he calls a stored energy effect. Silver and mining stocks have been suppressed or stagnant for so long that they've built up an enormous potential for upside once market psychology shifts. This potential is amplified by years of underperformance and investor neglect, which often precedes strong contrarian reversals. He believes that when this latent energy is finally released, typically triggered by a confluence of macroeconomic or geopolitical catalysts, the resulting price action will be swift and violent. As we present clips from Oliver's recent interview, please take a moment to like this video, subscribe to our channel, and turn on the notification bell for more videos. We appreciate the support and hope you enjoy the video.
I've pointed this out before, and it's not to make a projection of a target. If you go back and look at the 1976 corrective low in gold, which is around 100, it had been up to 275. Pull back to 1976 to about 100, went up to $850 3.5 years later, an 8-fold move. In the year 2000, 2001, gold was basing just above 250, okay? Never got quite to 250, but repeatedly tried. Stock market was topping then, by the way. In 2000, gold was bottoming, okay? Stock market topped, went down through 2002. Gold started its bull trend. It lasted until 2011. But by the time it got to its 2011 peak, it had another 8-fold move. You can see this on a logarithmic scale chart, where the move in 1980 and the move to 2011 were both the same scale when you think of a logarithmic scale or ratio gain, okay? If we do a ratio gain like that, we'll be at $8,000 plus because our bear market low was 1,050, okay? We've only had a fourfold, not even that, excuse me, a 3.4-fold. Okay? We're 3,400, we're 1,050, okay? We're not even halfway to the ratio gains seen during those prior two bull markets of the last 50 years. Now, in those environments that gold was in then, were hardly as catastrophic and as monetarily likely to be stimulated by central banks across the globe to try to put the fire out. So once they come in to put the fire out, that's when gold goes really berserk. And it's only just begun. Again, look at the T-bond market, look at the dollar index breaking, look at the stock market breaking, and look at the data points that will follow. The central banks they've only woken up They've hardly pushed the throttle. And when they do, gold will go berserk. It did in both those occasions. Only this time, the factors are far more explosive. And the alternatives in those two times were also T-bonds. If you go back and look at bear markets in the stock market, like 2000, 2002, or 2007 to 9, for example, T-bonds played pretty good then. You could have bought gold or T-bonds. They both worked out pretty good. Gold was ultimately better, but they worked. They were an alternative. They're not an alternative this time. Where do you go? You can't buy T-bonds. They're very dangerous looking. So all of a sudden, if you're looking to move money, billions of dollars out of your managed asset fund, asset manager, he's not even a gold bug, but he looks around and says, geez, it's the only place that's behaving. And when that money flows, it no longer goes into T-bonds and gold, it goes into gold, silver, gold miners. And that's what I expect to see. But the full throttle event hasn't even happened yet. And that's going to happen when that stock market blows that 4,800. The data points really go dark. T-bond crisis is suddenly not manageable. Already it's not really manageable on the central banks if they really panic, et cetera, et cetera. So all these things are working in gold's favor, but they haven't even hit the max point. Now, what's interesting is silver's behavior over the last 5-6 months has not matched gold's. Gold makes a high, pulls back, and takes it out. Silver made a high back in October above 33, above at 33. You can see on the top chart, the price chart, the weekly price chart, and it pulled back hard, and then came up to 35 in October of last year, and had another drop, and then again 4 weeks ago made a high at 35 again. So it went back up to the old high above 35, didn't go to 36, and collapsed with what? With the stock market break that occurred April 3rd, 4th, and on the opening of April 7th. A 2.5-day collapse in the stock market. Silver joined in. So did the commodity complex, by the way. Bloomberg Commodity Index, crude oil puked big time. Copper dropped pretty hard. So all commodities broke. Now, people think, therefore, by the way they treated silver in that break, that silver is just an industrial metal. And they mentally divorced it from gold, which is a mistake, because if you go back over history, they don't break apart. Silver follows gold ultimately, and often leads it. Okay, but you had this huge puke in silver, and you only had 3 or 4% drop in gold, hardly a drop, and yet silver dropped 35 to 27.5 bucks in a matter of days. Incredible wipeout, end of the world. Okay, then suddenly within we're now up to 33 again. Okay, either side of that, last week's high, this week's high. What that momentum chart below shows, instead of an upward channel that gold's been stuck in, since last May, that momentum chart made a high and has created a downtrend channel. Now, if that chart on the bottom were a price chart and you were a technician, you would draw the line we drew on that bottom chart, the momentum chart. We plotted it through 3 peak weekly closes. It's a downtrend, meaning if you now assert yourself and get back above that red line on that bottom chart, forget that it's momentum, pretend it's a price chart, you're breaking out. You've got a fresh buy signal. Well, what momentum is telling you is if you get back up in the high 34s again, we've been 33.20, I think, last week and this week. You go another $1.50, $2, get up to high 34s. So you have to get to 35 again. That's going to be breaking out, in which case it's saying, hey, that was a bear trap in silver. People made a mistake thinking silver must go down with the stock market. It's suddenly rejoining gold and is about to explode because you go through the top of that channel. That is a major momentum buy signal. And by the way, another note, whenever we can define 3 waves on momentum, down or up, clear waves, where there's no subjectivity to it. Clearly, there are 3 waves here since that peak back in May of last year on momentum. 3 waves down, that's all you get. And you've got a channel defined as well. So you've got 2 factors to employ there. You get up to the top of that channel again. So I'm telling you, if you're not in silver and you see it get back up to 34.90 or especially touch 35 again, assume it's going to launch big time. And I bet at that point, when that occurs, and we think it's going to occur, at that point, silver will launch versus gold. And so silver's relative pricing to gold, which is very cheap right now, historically very low, 1% of the price of gold. It's done that a few times before. And whenever it does, it slingshots, by the way. At that point, that's when silver says, me too. And I think that's about to happen.
Michael Oliver is sounding the alarm and the opportunity. The renowned momentum analyst has set high expectations for gold, silver, and mining stocks in 2025, backed not only by compelling technical indicators, but also by mounting macroeconomic pressures. Central to Oliver's outlook is the Federal Reserve's anticipated shift toward rate cuts and a likely return to quantitative easing. He identifies the recent weakness in the stock market as a key signal that the current monetary stance is becoming unsustainable. According to Oliver, growing instability in both the equity and bond markets will leave the Fed with little choice but to resume printing, igniting a powerful rally in the precious metals sector. In fact, there has been a lot of pressure on the Fed to start cutting in recent weeks. On Wednesday, former President Donald Trump criticized Federal Reserve Chair Jerome Powell for maintaining high interest rates, suggesting the central bank is hindering stronger economic performance. Speaking at an executive action signing ceremony, Trump stated he might contact Powell directly, claiming the Fed is making a mistake by not lowering rates. Despite having nominated Powell in 2017, Trump has frequently criticized him, most recently calling him a major loser and questioning his leadership. Oliver says it's only a matter of time before Powell gives in to the pressure. Let's get back to the video.
What do you think Jay Powell does? You mentioned earlier he's
It,
already
it
back
could be
into a
that,
corner.
that argument there could be a delaying factor for Powell, because he's got to have justification other than simply Trump said to cut rates. He's got to have some bad numbers. That means he's got to literally wait for some horrible data points, unemployment numbers, all kinds of other data points they look at. They need to have some dark numbers. And so they can say, our other mandate is in play now, the economy and unemployment. Otherwise, he's given in to Trump. So that means if he might have done it earlier, otherwise, he's not going to do that. So he will definitely delay. That's fine. It doesn't matter. We showed charts of 2000, 2002 S&P and 7 to 2009 the S&P, and put arrows on the charts all the way down. Arrows were the Fed cut, Fed cut, Fed cut, Fed cut, Fed cut. It didn't mean anything. It meant something to gold. It didn't rescue the stock market, because once those bubbles break, the bubble takes over. The central bank is merely a road bump in the process of liquidating the bubble. And we right now have the biggest stock market bubble in U.S. history, both in duration of time, time spent and percentage gains. So welcome to the party. I have no idea. I don't predict the Fed. I just know that historically, when you go back and do your homework, it doesn't matter. When they start cutting rates after a period of pause, they may raise rates for a couple of years, then they pause. And when they start cutting, the market starts down, or have already started down, and it doesn't help the market historically.
In other words, it's too little, too late. They're way behind the curve.
The fire started. You're not going to put it out with a tiny hose. They'll have to go to QEs, and those won't work either. Even when they did, if you go back and look, we did a study of this because everybody has this burnt in their memory. If the stock market goes down big, gold will go down. There's 1 month that's got everybody concerned, and that was October of 2008. The S&P dropped 30% that month, meaning a crash event. But that was already a full year off the high. It had been going down hard for a total year. And then finally, a month after Lehman went under in September 2008, the S&P puked 30 some odd percent. That's when Bernanke came in, took the little Japanese trading book, QE, and deployed it. And in November, 2 months after Lehman went under, and a month after the stock market puked, already a year into a bear trend, he finally did QEs because rate cuts hadn't been working. And you know what happened in November? Stock market went down hard again, and it kept going down till March of the next year. 30 more percent drop, even after he did QEs. What happened to gold? In October, it did have a sell-off. It was a corrective, brief sell-off in August, September, especially October, where it needed to correct. It had a huge move at that point. Even while the first year of the stock market had been going down, gold's still going up. It was only in that later part of 2008 that finally the stock market had a puke that gold said, I need to correct anyway, and it had a very bad month. But when they did QE, stock market went down another 30%. Gold exploded in November when they did the QE and was back to its highs by early 2009, on its way to 1900. So again, what the Fed does, don't count on it helping the stock. In fact, when they start cutting rates, panic because they're admitting, okay, that's when they scream. Okay, so they're late to the game. But when they start doing what the head of the Boston Fed, the woman who's head of that, spoke Friday a week ago and said, we've got various tools to employ if things start to happen like that. And she meant not just rate cuts, like QEs. So that was an admission that was quite revealing.
Michael Oliver's analysis reminds us that markets don't move when the crowd expects it. They move when pressure beneath the surface finally breaks through. Silver and mining stocks may look quiet on the surface, but under that calm lies a tectonic shift in momentum, fueled by years of neglect, undervaluation, and now, accelerating macroeconomic stress. This is more than a bet on metals. It's a bet against a monetary system running out of options. As the Fed inches toward inevitable easing and political voices grow louder, the question isn't if the breakout will come, it's whether you'll be positioned before it happens. Smart capital isn't chasing yesterday's headlines. It's quietly rotating into tomorrow's story. And if Oliver is right, silver is tomorrow's story. So ask yourself, are you ready for what's coming? If this resonated with you, hit like, subscribe, and turn on the bell, because in the weeks ahead, we'll be diving deeper into the unfolding shifts in the global financial system and how you can stay ahead of them. Thanks for watching, and see you in the next one.